people, I think, particularly abroad, by abroad I mean outside America, and particularly in Asia, are realizing to get out of Western currencies, get out of credit. And then what do? They all know that real money is gold and silver. I mean, they're not buying silver. Silver isn't being priced as money at all. We can come on to that in a moment. But, I mean, really led by the central banks, sovereign wealth funds, I guess, some of the very, very wealthy billionaires in Asia, of which there are increasing numbers, they're buying gold. And not only that, but I mean, we had the story about 3 weeks ago about how insurance companies were being given the green light to do a pilot project of putting up to 5% of their assets into gold, physical gold. And we were looking at something like, I mean, this was just restricted to about half a dozen insurance companies. And that was, what, sort of 300 tons or something? And that really did seem to get things going. That is going to, I guess, be expanded because if you're in China, the only decent performing asset is gold. So where do you go? You know, why am I restricted? Why am I not allowed to buy it? And as to another point, you know, the Chinese housewives are avid savers. They save something like $2 to $3 trillion equivalent a year. And of course, property's bitten the dust now. Stock market is uncertain as far as they're concerned. They've only got bank deposits, and the rates have been cut recently, or gold. And most banks offer a gold account. So I think we're seeing quite a lot of that savings, if you like, going into gold accounts. I mean, it just makes so much sense. As soon as you understand that gold is money and the rest is credit, which I think increasingly these Chinese people do, then, you tell your bank, please open a gold account. Here's my initial deposit of 500 yuan or whatever it is. And I'd like to add to it with 100 yuan every month. You know, and you've got millions and millions of people doing this. So I think that's really what's accentuating the shortage of bullion in the West. And then there is another factor, of course, for whatever reason, and we can go into that in a bit maybe, but for whatever reason, gold has been arbitraged into the COMEX warehouses from virtually everywhere else. So there is no liquidity in London, there's none in Switzerland. There's none in other centres either, really. I mean, even Mumbai, or Bombay as I was about to call it, even Mumbai has sent gold over to benefit from the arbitrage. I mean, they're getting something like $50 an ounce on that. That I think is, I mean, looking at the COMEX warehouse figures, I think that's now appalling. But there was an interesting factor in this, and that was that the queue of people or institutions, businesses, trying to take gold out of the Bank of England. Now, the Bank of England doesn't actually store very much gold for commercial entities. It predominantly stores it for central banks. So we don't know for certain, but I feel pretty sure that much of the gold that was taken out of the Bank of England and is still being taken out of the Bank of England is actually leased gold. Now, I don't think that's the deal which the lessors actually anticipated, because really, I think for the last 20 odd years, maybe longer, the Bank of England has run something they call a book entry transfer system. In other words, they will run books to show the actual ownership of gold. So if you're a central bank and you lease your gold, the ownership changes. It's actually as simple as that. You don't have any right over that gold until the lease expires. But the point is that gold leasing has provided the liquidity in the London market and been a central part of the liquidity, and also has been part of the liquidity which the Bank of International Settlements uses as well. So you've got these sort of powerful forces which have kept some sort of order in the market, if you like, in London and also Switzerland. And it's relied on the liquidity from leasing. Now, we see central banks accumulating gold, like 1,000 tons every year for the last 4 years, and I guess that they're placing an even greater urgency on accumulating it. It makes no sense for anyone in the central bank cohort to lease their gold. So I guess that as these leases fall due, they're not being renewed. The effect actually could be systemic, because this gold, it's leased, let us say, for a year or two to a commercial entity, a bullion bank, say, and then it rehypothecates that probably to someone else, and it may be rehypothecated to another somewhere else. So you could probably have 4, 5, 6, 10 owners, essentially, of a particular piece of bullion. So you can see how important it is to the overall liquidity of the market because of the way in which this leasing works. So if that is coming to an end, then there is a crisis developing in the market. That is the point. I suspect also that the central banks see this, and many of the central banks, and remember the central banks do talk to each other, and they have a bi-monthly meeting under Chatham House rules at the Bank of International Settlements in Basel. So they talk to each other, they know each other. So, they know why other banks are buying gold, even if they're not. And if they're not, it's because of policy rather than, sort of, if you like, apathy or some sort of belief that we shouldn't be doing this. So I think this central bank story is going to tighten and tighten and tighten on the market. It's just really going to squeeze it. And interestingly, I mean, we've had some days when we have seen the gold price rise very, very sharply, with open interest on COMEX actually contracting. It's not the hedge funds who've been buying it. I mean, yes, they're in there to an extent, but basically, it's the system which is in the squeeze, which is interesting. Now, I think you could probably divide the bullion bank community into two camps. You've got the big boys, who I think have probably got bullion. They've got some liquidity. And I think this is why they feel quite relaxed talking about, we expect gold to go to 3,500 or 4,000 if following happens, whatever. So they're quite happy to talk it up because they've got a bit of stock on board. But I don't think that's the case with most of the smaller traders, bullion bank trading desks in the market. And they could be getting into some serious difficulties on this. So I think that's where we are with gold. And the important point is that the people who are buying it actually realize that it's not gold going up, but it's the dollar going down, or the euro going down, or sterling, or whatever your currency is. That is the important point. The people who are last to understand this are the users of an actual currency. So in the case of the dollar, the last people to understand this are its users. Second to last are the institutions that manage the user's savings, capital, wealth, whatever. They've been out of it for so long. And of course, the other thing is that the brokers they don't cover the sector really. I mean, gold coverage. I mean, for a start, they don't understand economics. They understand macroeconomics, but that's a non-science. They don't understand money, credit, relationships, etc. Most of them don't even understand how banks create credit. I think that they're going to be gradually waking up to the fact that they're missing out on a story here. They won't know why they're buying it, but they're coming under pressure to buy it, because the best performing asset in first quarter 2025, without a doubt, was gold and gold-related investments. So we're beginning to see that shift. And if you look at the most recent figures for global ETFs, which were March, released by the World Gold Council last week, I think, they're beginning to buy the ETFs. The amount of ETFs were increased, if you like, outstanding increased by a net 90 tons. Doesn't sound a lot. Maybe not a lot, but we're only talking about 1 month, and that's going to put added pressure, I think, on the market. So I think that's roughly where we are.